We've now delivered over 1,200 Roadsters in 28 countries, built a worldwide network of 13 stores, and established relationships with two major OEMs to provide electric powertrain development services and components. During the last 12 months, we've also increased our gross margin on the Roadster by improving our top line as well as controlling our variable costs. To achieve all of this, we put in place key operational, recruiting, and IT infrastructure around the globe and grown our engineering and manufacturing talent. You'll see that we've continued this growth in the current quarter by hiring over 100 people, a 21% increase overall from the last quarter, primarily, again, as Elon touched upon, in the areas of engineering and manufacturing. We now have about 680 employees around the globe. We've also completed the consolidation of our powertrain engineering teams and our manufacturing facilities at a single location at the Tesla headquarters in Palo Alto, California. We continue to stay focused on developing the Model S in a capital-efficient manner. As a Silicon Valley company, we have demonstrated with each model release of the Roadster that we can work faster and be more efficient in our spending. The full spending required to bring the Model S to market is currently expected to be about $400 million. This is primarily funded by $364 million of the total $465 million loan facility from the Department of Energy, which allows us to borrow at Treasury rates. With this loan and the $234 million raised from the successful completion of the IPO and the investment by Toyota, we believe we have sufficient capital on hand to bring the Model S to market, expand our global operations to support this revenue growth, and start parallel development of additional models. It is the combination of the Model S opportunity, our capital efficiency, and the leverage of the DOE loan that we believe creates long-term value for our shareholders. With that overview, I'll now turn to our financial results. Two quick comments. First, even though our stock started trading on June 29th, the IPO didn't officially close until July 2nd. As a result, you will notice that the IPO proceeds and Toyota investment do not appear on our Q2 financial statements. This ripples through the financials in several areas, including our share count. We have footnoted the financial statements in the press release in all of these areas for your convenience. Second, I'll be providing additional commentary on our financials on a non-GAAP basis, as this is how management measures Tesla's results internally. Our non-GAAP results exclude non-cash charges related to stock-based compensation and the change in fair value of our outstanding preferred stock warrants. However, as you know, non-GAAP information is not prepared under a comprehensive set of accounting rules and therefore should only be read in conjunction with our GAAP results to evaluate our performance. A reconciliation of the non-GAAP information for all quarters mentioned on this call is also included in our earnings release posted on our website. Turning to the P&L, our revenue for Q2 was $28.4 million, a 36% increase sequentially, and a 5% increase year over year. I want to remind you that in 2009, we were shipping aggressively against a 2-year order book. So a sequential comparison is more meaningful, and it clearly shows the growth achieved in all areas of our business. We report revenue in two categories: automotive sales and development services. Automotive sales increased 16% sequentially to $24 million in Q2. Automotive sales consist primarily of Roadster sales, including options and zero-emission vehicle credits. As Elon noted, Roadster orders in this quarter were at their highest level since Q3 2008. Consequently, we shipped 12% more Roadsters compared to the last quarter. Roadster ASP in Q2 was 24% better than the prior year and held almost steady as compared to the last quarter. Automotive sales also include the shipment of powertrain components to OEMs, which in this quarter were battery packs and chargers delivered to Daimler. These sales almost doubled to $4.8 million in this quarter, driven by record shipments to Daimler, a great result from our powertrain operations team. Development services revenue consists of services we provide to other OEMs to develop electric powertrain components and systems. We began recognizing revenue from the A-Class agreement with Daimler in Q2, which amounted to $4.4 million. This compares to $200,000 recognized in the prior quarter related to the prototype packs developed for Freightliner. You'll start to see revenue from the development of the electric RAV4 prototypes for Toyota to show up here in the second half of 2010. Total gross margin for the quarter was $6.3 million at 22%. This compares to 19% last quarter and 8% in Q2 of 2009. The 22% gross margin is a record for us, and we are very pleased with the result. The gross margin from our automotive sales was just under 16%, slightly lower than the prior quarter, partially due to one-time expenses related to the launch of Roadster 2.5 towards the end of the quarter and weakness in the euro during Q2. As compared to a year ago, the substantial increase in gross margin was achieved by improving the top-line revenue of the Roadster as well as controlling our variable cost. We've achieved significant material cost reductions through redesign or resourcing of our powertrain components, HVAC system, and wheels as examples. Finally, it's also important to note that the gross margin of 58% for our development services is not an indicator of gross margin for these activities in future quarters. We incurred costs related to our Daimler A-Class agreement in advance of finalizing the contract and had to book them as R&D expenses rather than costs in Q1. However, some of the deferred revenue on this program from Q1 was booked in this quarter when the agreement was signed. Hence, revenue and costs were not fully matched in Q2, as accounting standards around revenue and expense recognition have led to timing differences. Going forward, such factors will continue to complicate the gross margin of this program, and for that matter, other such programs in any given quarter. Looking at our operating expenses, they reflect our continued emphasis on the development of the Model S and its infrastructure. R&D expenses were $15.4 million for the quarter on a GAAP basis and $14.9 million on a non-GAAP basis. Non-GAAP R&D expenses increased 14% sequentially. We'll continue to ramp up the spending on Model S development with increased internal R&D resources and further engagements with suppliers. The timing of payments to suppliers depends on many factors, so we anticipate that R&D expenses will continue to increase significantly but may not have a predictable trend. SG&A expenses for the quarter were $22.2 million on a GAAP basis and $16.7 million on a non-GAAP basis. The increase in our SG&A expenses on a non-GAAP basis from the prior quarter occurred as we have continued to expand our presence globally, as well as establish our network of company-owned stores. We also incurred higher expense related to the recruitment of key talent from all over the world, new filings for our patents and trademark protection globally, as well as facilities expenses related to the consolidation of our engineering and manufacturing center at our headquarters in Palo Alto. A quick comment on the charges in other income and expense line. This reflects the change in fair value of our outstanding convertible preferred stock warrants and the DOE warrant at the end of the quarter. Since our stock price closed at $23.83 on June 30, this non-cash accounting charge was $6.3 million. Net loss for the second quarter was $38.5 million on a GAAP basis and $26.1 million on a non-GAAP basis. This compares to a non-GAAP net loss of $23.8 million during the prior quarter. As Elon mentioned, we are incurring a net loss and will continue to do so for the next several quarters as we are making significant investments to prepare for the launch of the Model S, which will grow deliveries by almost 40 times those of the Roadster in the next few years. Were we not in this aggressive growth mode, we believe that our business could be right-sized to deliver a net profit based on gross margins in the range of 20%. While looking at our losses on a per-share basis, please note that weighted average shares were only 7.6 million since the IPO did not close until after quarter end. This resulted in a net loss of $3.41 per share for this quarter versus $3.26 in the last quarter, again on a non-GAAP basis. Our pro forma basic common shares outstanding would be approximately 93 million shares, considering the IPO and the investment by Toyota, as well as the automatic conversion of our preferred stock and warrants. On a pro forma basis, therefore, our Q2 non-GAAP net loss would have been 28 cents per share, assuming that the share count was outstanding for the entire quarter. Turning now to the balance sheet, cash was $47.3 million versus $61.5 million at the end of the prior quarter. As I noted earlier, this doesn't include the $235 million raised on July 2nd. Looking at cash flows, cash used in operating activities during the quarter was just under $18 million. This is less than the $27 million used in the prior quarter. Capital expenditures were $9.2 million this quarter, driven mainly by increased investments in the Model S program. Offsetting our cash usage in the quarter was a drawdown of $15.5 million from our DOE loan facility. At this point, I want to make a couple of points regarding the DOE loans. First, to reiterate my prior comment, we expect that the loans will pay for most of the costs related to the engineering, development, and facility expenses for the Model S until its launch, and for all such expenses of our powertrain activities on a reimbursement basis. So almost all of our cash burn from R&D and CapEx spending for the Model S business is eligible for reimbursement. Currently, there's about a 6 to 8 week lag in reimbursement between when these costs show up on our financial statements and when we receive funding. We estimate that about $12 million of our expenditures incurred through June 30 are eligible for reimbursement by the DOE. Also, as of June 30, we have drawn down $45 million of the loan facility, and the remaining $420 million can be drawn over the next 2.5 years. Think of this as a $420 million credit line. These loans extend until 2022 and allow us to borrow at Treasury rates with quarterly principal repayments that start at the end of 2012. Second, I want to explain what will happen to a portion of the IPO proceeds in connection with the loans. As some of you may recall, we agreed to set aside $100 million of the cash raised into a dedicated account. As a result, our Q3 balance sheet will show this as restricted cash. This dedicated account can be used for us to fund any cost overruns for our powertrain and Model S projects, and will also be used as a mechanism to defer advances under the DOE loan facility. This will not affect our ability to draw down the full $465 million loan, but will require us to use the dedicated account to fund 50% of the project costs up front.